So today I am joined by my colleague Steve Martin, and we're going to talk today about investing. And you may wonder what that's got to do with divorce, but once you've received your settlement and you have a lump sum or you have a pension share, you're going to want to do something with it other than holding it in a bank account. So Steve is happily joining us to talk all about investing, and he holds the investment management certificate, which is why I've asked him to come and join us today to
there we
talk
go.
on this
I did wonder. Excellent. Morning, Tamsin. Thank you for having me on.
Thank you for joining me. There is method in my madness. So I guess the starting point is for people who haven't looked after money before or who haven't been involved in investment decisions, why would you invest?
I think at its very most simplistic, the idea of investing is about sort of sacrificing now for something in the future. So, it's almost like a delayed gratification idea. So I need to put money aside now and as I say, sacrifice my lifestyle now because I know I'm going to need some money in the future. The reason that we would invest in the way that we would understand investing, as opposed to simply putting money under the pillow in a safe, in a bank deposit box or in just in a normal bank account, is usually because if we're going to make that sacrifice now, it would be nice to think that it's bigger when we go to use it at some point in the future. So the basic principle of why would we want to invest is to get a reward for the sacrifice that we make now by having more resource available to us at some point in the future.
Okay, I got that. So a question that's asked to me a lot at the moment, because we've seen interest rates go up over the last sort of 9 months or so, is, well, investments might go down. If I put my money in a deposit account, I can get 4.5%, maybe even 5%. It's a little while since I looked.
I looked yesterday, funnily enough. So yeah, you can get 5 on sort of maybe 3-6 months notice accounts and 4.5 on instant access as at kind of late July time.
So why would I not do that?
A number of reasons. The most important being that even if you can get 5%, even if you're prepared to put the money aside for 3 or 6 months and you don't need access to it, the 5% return that you get on your money, you would then pay tax on. So if you're a basic rate taxpayer, your 5% is taxed at 20%. Assuming my maths is decent, that means that you're going to get 4 that you actually get to keep. Which in the face of it, you think, okay, that's great. I've got 4% more next year than I had this year. The only trouble is that inflation's higher than that. So inflation is the reduction in the spending power of our money. So what we can buy with £1 this year will not buy us the same amount of stuff next year because of inflation. So inflation is, this I didn't check, but somewhere around 7-ish% at the moment. So therefore, actually what you're doing over that year is guaranteeing that next year that piece of money that you've set aside will buy you less than it buys you today. And if you think about what I said originally, what's the point of investing? It's about rewarding the sacrifice that you make by not spending it now so that you have more resource available to you to spend in the future. So whilst it looks like a good idea to get those cash rates, actually what you're doing is making your money less valuable in spending terms next year than it is today, which isn't a great idea.
Fair enough. No, that sounds pretty sensible. So the other thing that I hear often commented is investing's really risky. It's really worrying. I could lose all of my money.
Sure.
And either if I decide not to put my money in cash, maybe I'll just go and buy some property instead. So I guess there's two bits to that question. There's what's the I know. What's the risk bit? How do I deal with that? and then there's the property thing, which most people in the UK understand investing in property. They can reach out and touch the bricks.
Sure. Okay, well, let me answer the first bit, and then if I forget the second bit, you can ask me that again, because I think even your first bit has there's two parts to that as well. So risk as a subject is an enormous subject. In fact, I'm fairly sure somebody not very far from me on our video call did a master's around investment risk. So risk in real life means, do I want to climb a tree or not because I might fall out? Do I want to skydive? Do I want to drive my car really quickly? Do I want to start a business and leave my salaried job? Risk has got such a huge amount associated to it. And normally, in normal life, it's the risk of something pretty catastrophic happening. But I've just used the word, isn't it? Which is kind of cheating. It's like playing one of those describer games and then actually just saying the word. So, in normal life, the consequences of some of these decisions could be huge. We went relatively recently to the Eiffel Tower, and the kind of guide lady regaled us of this story of a chap about 100 years ago who decided he would jump off the middle level with a blanket because he reckoned that was going to make him fly. Now, for me, that was a super high risk decision because, needless to say, he's dead, and he was dead immediately. And apparently, because of the way the human body works, he actually had a heart attack on the way down because his body worked out that's what was going to happen. So he'd had a heart attack before he's even hit the ground. And I can't remember how high it is, but I think it's about 350 steps up. So I don't know. Let's assume it's 100 meters or something. No, it won't be as much as that. Anyway, it's not all that far. And the body's gone, oh, we're just going to shut down because you're going to hit the ground. And needless to say, didn't go up again. So that is risk, in the most preposterous of senses. So if we take that general sense of what we feel is risk and how we react emotionally to the idea of risk. I mean, risk could be as simple a thing as, letting your 16-year-old kid go out with their friends in the town in the city of Manchester on a Saturday night without being supervised. Positively frightening as a concept. So it's a really wide subject. But so we bring it back to investments. Risk fits differently in investments than it does in the rest of the world. So there's two, and the point of this whole story is there's kind of two groups of investments. Some things where risk is a time issue, and some investments where risk is a bona fide risk of losing everything. And the distinction that we would probably use as professionals is the difference between investing and speculating. So I could go to the bookmakers and put £10 on a horse and it could win at 10 to 1. And I made 100 quid, yay. But the probability is it won't win, in which case I lose all of my money. That is not investing, that's speculating. So if it works, fantastic. If it doesn't work, disaster. Speculating is something that we don't want to do as part of our objective of taking the resources that we have at the moment and trying to make them have an increased spending power in the future, because there is a genuine risk of catastrophic and complete loss. And I think this is where, for a lot of people, this is where the problem comes, that the information isn't clear as to what is investing and what is speculating. So just to give some kind of common examples, crypto is speculating. If you invest in cryptocurrency, you are speculating. If you invest in NFTs, which for our younger audience, they might know what they are. I only know because my younger audience, i.e. my children, have told me what they are. So if you invest in things like that, it's speculation. But on the other side, there are investments where risk we can think about differently. So if I just stay with speculation for a second, for me, the distinction between the two things is we are speculating if there isn't a genuine reason as to why the decision that we've made will increase in value. And that whilst we have it, we get some sort of return from it. So we're rewarded for holding the thing. We're not just waiting for some magical outcome in the future. Okay, so again, if we take cryptocurrency as an example, I could buy Bitcoin or Ethernet or Dogecoin or whatever. And the time I hold it, nothing happens. I don't get interest, I don't get rent, I don't get dividends, I don't get shared, nothing. Literally nothing happens. I'm holding it and I'm crossing my fingers that somebody in the future will buy it from me for more money than I've bought it for. As a result of that, nobody can make a financial model with any validity that suggests why that should go up in value. And I could bore the pants off you with stories of this, but there's a very famous story from the 1700s where people were speculating on poppies and they bought them and they kept buying them and they kept selling them and the prices kept going up until the day they didn't. And then the last person was left holding the baby. They had lost all their money because suddenly everybody realized, why are we spending this money on poppies? So therefore, in the speculating category, we've got things like cryptocurrency, as I said. We've got your NFTs, art, wine. Help me out here. What other kind of example? Oh, gambling on horses.
Gambling. That's got to be the biggest one, hasn't it?
Horses or casinos or whatever else. And again, there's no harm as part of a wider view of your finances. There's no harm in having a relatively small amount of money. That if you like betting on the football results, or you like going to the casino, or you like going to the horses, for a little bit of money to be allocated to that. But the trick is you have to allocate it on the basis it's lost. So when I used to live in Altrincham, we would go to Chester races sometimes, and I would go with £10 to lose on every race. And that was my mentality. I was going to give the bookmaker £10 on every race. And if he or she happened to give me some money back, it was nice. That would go towards dinner after we'd been at the races. I wasn't going there expecting to do anything other than lose 60 or 70 pounds plus food or drink. Yeah. And the same goes for whether whatever else that is. If you've got some super hot tip and you think that, I don't know, let's say a year ago, somebody told you that Nvidia was going to be the future and you wanted to buy that one thing, well, buy it on the basis that the money's lost to you. If it happens to go up in value, you can brag about it at a dinner party or to your mates down the pub. Same thing goes for crypto. If you've got £100 that you want to gamble on crypto, go for your life. But don't gamble with the money that's designed to support and fund your lifestyle and your family's lifestyle in the future, because that is actually what you're doing. So if we go to the other side, gold, silver, commodities, those are in that category as well. So you buy gold and hold gold, and whilst you own it, you might be able to wear it on your finger or around your neck or something, but it doesn't give you anything. You get no return. In fact, usually when you own gold, there's a cost associated. And whether it's a security box at the bank or whether you have it held in a vault or something, somebody has to be paid to, or even if it's just an insurance policy for your house, there's a cost associated to owning this thing as opposed to a return coming from it. Whereas if we go to the other side of that, even back to our building society or bank example, whilst the bank's got your money, it's giving you a return. As I said before, the return that you're getting will be less than inflation, so it's not ideal, but it's still investing sort of, because you're getting a return on the money whilst the money's doing something. So the broad kind of category of things that we would consider as investing would be cash, would be property, and would be companies, would be shares. There's also a thing called bonds or gilts, which is kind of where you lend money to companies or governments and they give you a return as well. So that's the key distinction I want people to take away. Investing is something where you're getting a return whilst you're doing it. Speculating is where you're waiting on an outcome at the end, a sale, in order to either make money or lose money. And you can make an awful lot of money or lose an awful lot of money. But whilst you hold that thing, you don't get any return for your money. So it can't be an investment by my definition. Anyway, so if we go into the investment side, so if we start to think about investing as cash, these bond or gilt things, property and equities, when we invest in any of those things, they will give us a return. They'll give us a return dependent on lots of different factors, but we'll get a return. We'll get a reward for actually owning it. So if you own a property and you rent it out, you get a return, you get rent. If you own shares in a company and they make profit at the end of the year, they distribute dividends, so you get a return for holding it. If you lend money to companies or governments, they pay you an interest rate for the use of your money. And similarly in the bank, if you put money in the bank, as we know, we get an interest rate for doing so. So we're now talking about investment. So as I say, the most important thing, therefore, is to understand the difference between investing and speculating. So if we now stay in the investing category and then start to think about risk, what does risk really mean? Well, risk in an investment sense is one of two things, really. It's either a timing issue or an income issue. What do I mean by that? So from a timing point of view, if you invest in any of those four things, cash, lending money to companies and governments, property or equities, if we go back and look in history, it shows us the value of these things always go up. Always. And I've got some data that I can give you, I think, if it's useful. But they always go up in value. The trouble is they don't go up in a straight line. And here's the really annoying thing. The higher the return, the less straight line the returns that you're actually getting. So the highest, the best returns that we get from investing, not speculating, investing, is investing in companies. And if we go back over 100 years, the return on investing in companies in the UK has averaged 12% per annum. And in global companies, 13% per annum. However, we don't get this perfect straight line. And this is where people start to feel risk. Because whilst we've averaged 12 or 13% per annum over 100 years, some years the value of those companies will be up enormously, and some years they will have fallen enormously. So when I talk about time being the issue, the risk that you have is that if you're not able to wait out that time, then you might have less money than you started with. However, I spoke to a lady recently, and we had a conversation about this idea of investment time horizon, horrible jargon, okay? But basically the idea meaning, how long am I going to invest my money for? And she said, I think I'm investing it for 1 to 3 years. And she's in her late 50s. I said, no, you're not. You're investing money for 40 or 50 years, depending on how long you live. Your investment time horizon is the rest of your life. She's retired, she's got capital, she's got a couple of other bits and bobs going on, but her investments are there to deliver an income for the rest of her life. That income for her needs to keep pace or grow faster than inflation. So if we put that money into cash, we fail, because the money will always underperform inflation. Inflation will always be higher than bank account rates, and then bank accounts, as we talked about, are taxed. Now, I don't want that to sound misleading. All investments will be taxed unless they're in a tax advantage structure. So it's not an apples and pears thing, but the rest of the investments are likely to produce a return that's greater than inflation after tax, whereas bank accounts are likely to produce a return that's less than inflation after tax. So we need to think about this idea of investing, and we need to understand the variability of returns and start to think about that rather than thinking about it as risk in absolute terms. I hope that's not too complicated.
No, I think that sounded fairly straightforward. One thing to touch on, so you mentioned about the loans to companies and loans to governments. So they're called bonds.
Yeah.
And there are numerous things in our world that are called bonds. that aren't necessarily the same thing,
sure.
which I know is why you've said they're loans to governments or companies when we've been
Yeah.
talking. But I just thought it might be useful just to touch on the fact that they're often called bonds, and
Yeah.
there's loads of other things called bonds as well.
Yeah, you're totally right. There's lots of different things called bonds, and they do mean completely different things. As I said, the bonds I'm talking about is where a company or a government issues. If you're a government, you can't go to RBS and ask for a £250,000 mortgage because what you're wanting to borrow is probably 3 billion. So, and when you're a large company, so if you're a Tesco or a Vodafone or whatever else, same principle applies. You can't go to the bank and say, can you lend me multiple £1,000,000? Because that's simply not possible. So what these institutions, as I say, either governmental or big companies do is they go to the investor market and say, we would like to borrow £1 billion because we need to fund I don't know, a house building, HS2, let's say. So government says, I need to fund HS2, I haven't got enough money, I want to borrow it. And here's my terms. I'd like to issue in £100 chunks, I'd like to issue a piece of paper that says, I owe you £100. So you, the investor, gives the government £100, they give you a piece of paper back saying, I owe you £100. And whilst I've got your £100, for example, the next 5 years, I will pay you an interest rate of 4% per annum, or 6%, or 10%, or 2%, whatever. So you give the government the money, you get your interest payments as agreed by the terms, and then at the end they give you your capital back. And the rate that you get for these things, it is effectively a negotiation between the person that wants the money and the person that's going to give the money. Now, I don't mean that on a one-to-one basis. We don't sit down with the chancellor and say, I've got £100, what rate are you going to give me on my money? It's kind of as the market as a whole. So they would go to the market and say, you know, if we were to ask for £1 billion, and if we were to offer a 5% rate payable over 7 years, who would buy it? And, you know, the big institutional investors might say, nah, no chance. You need to make it a higher rate than that. And then, you know, so it kind of ends up being done like that. And again, the way that we access these things is usually through funds rather than buying them individually, because it's too difficult and too costly to buy them individually. So usually what we would do for ourselves, for clients, is that we would buy them through funds so that somebody else is doing that kind of negotiating on your behalf. But again, we would want to make sure that those funds are as low cost as possible, because we don't want to give any of your return away to somebody else unnecessarily. So the idea is something that most people will be able to understand. I give you money, you give me an interest rate for a period of time, then you give me your money back. But we would use a fund to access that rather than try and access it ourselves.
And so a fund where lots and lots of people all club their £100 together, or whatever that amount is, and somebody would look after that negotiation on their behalf, as you said.
Yeah, it's a little bit like a wholesaler. So if you go to something like Macro, for example, Macro buys stuff in huge volume from the manufacturers and then sells it on to retailers who might be corner shops or restaurants or whatever else, who are then going to sell it on to somebody else. So a fund's like a Macro. It's like a wholesaler in that sense, that they can buy huge amounts of stuff at a relatively low price. And then the retailers, i.e. us, can buy little bits of that, benefiting from kind of the buying power of the wholesaler. That's the idea.
And so similarly to what you've just explained with funds and bonds, we would do a similar thing for shares. So why would we do that for shares? Why wouldn't we just go and buy a share in Tesco or Apple or Microsoft?
I think there's a couple of reasons. The first one is that wholesale, resale, retail kind of concept, that If you go and buy them individually, you're paying individual trading costs every time you do that. So you pay to buy the share, you pay to sell the share. So it's partly that, although to be fair, in 2023, those costs are really low. If we go back 20 years, those buying and selling costs would have been really quite expensive. The much, much bigger issue, and we could talk about this for days, is about trying to diversify our risk. Again, we're into jargon, but basically what we're trying to do is make sure that we are not entirely dependent on the success or failure of a small number of companies. So instead of buying Tesco, the research and all the kind of economic research from the past shows us that the expectation that we would have of what rate of return would we get in our money doesn't increase or decrease if we buy one company or if we buy 1,000 companies. Now, we might be right, we might be wrong, but the expectation of the return doesn't change. The risk associated reduces enormously because we're not dependent on the success or failure of one company, one CEO, one adverse comment to a journalist, as we've seen with NatWest recently. The value of NatWest has plummeted in the last week or so due to the Farage stuff, because it's just one company. There's famous examples in the past of there was a BP pipeline, I'm sure lots of people remember, that blew up and poured oil into the Atlantic, and the value of BP dropped enormously. Enron's a famous company in the past where it became apparent that actually it had been overstating its profits, overstating its turnover. So if you buy one company, you have a real risk that something that A, hasn't happened yet, or B, you don't know about, could happen and hugely negatively or positively impact the returns. Whereas if we buy 1,000 companies through a fund, again, through this wholesale kind of idea, then economic theory tells us we have the same expectation for increasing value over the long term, but we've now meant that in my example, if we own BP, then we have a really negative experience for 1 out of 1,000 companies as opposed to 1 out of 1 company if we bought that. And again, just a little history on that. Very commonly in the past, UK stockbrokers would build what they called dividend portfolios. So there was lots of retired people, and especially unfortunately, there was lots of widows who had investment portfolios previously built by stockbrokers, and they were invested in a relatively small number of well-known UK companies. So we're kind of talking mid-2000s here, and for a long time in the past. When the credit crunch came in 2008, or the what was it called? The Great Financial Disaster or something. There's all sorts of different names for it, isn't it? But when the world had a horrible time in 2008, that specific set of companies, because there was in general only 10 to 20 of them, were disproportionately harmed by what was going on in the world relative to the rest of the thousands or thousands of companies that you could have invested in. So for people who had made those kind of investment decisions, they suffered disproportionately to people that had invested in a wider sense. So in a very simple sense, we're trying to avoid being in a situation where something that nobody could have imagined has an unnaturally big impact, big negative impact on the companies that we've invested in. And the way that we do that is to spread the money around as widely as possible so that we minimize the impact of any one company or one sector or one country or one currency having a bad time and therefore massively impacting our money and our futures.
Okay, that makes sense. So where does property fit into this? I guess more than anything, you know, most of us in the UK own our own homes. And it's not the same as that all across the world, but it is the case in the UK.
Sure.
And so, as I said before, we get it. We understand property. I can, you know, if I buy the house around the corner, I can reach out and touch the bricks. I know it's there.
Sure.
If I invest my money in the investment funds that you've just described, that feels more scary because I can't
Yeah.
reach out and touch it, and I don't necessarily understand it thoroughly or know exactly where my money's going. So
Sure.
why would it be a better idea to do that rather than buying a house and letting it out?
So I think if we talk about it feeling more scary, that's an entirely natural response to something that's unknown. So if you've never invested in companies before, either directly or through this kind of wholesale fund idea I've been talking about, it's natural that you're going to have a reticence, have a fear, because you don't understand. Before you'd ever bought any property, you would sort of be in the same place. So there's a disconnect between the level of knowledge that people have, and that manifests itself in uncertainty, which is perfectly reasonable. So one of the things that people can do is educate themselves. So you can actually, I mean, there's, you know, the internet's full of it, and we've probably got some resources that we can make available to people that they can have a look at as well. But you can learn and understand a little bit more about it so that you start to feel a bit more comfortable. And again, if you were investing in that basis, you know, that kind of diversified basis, you can still go and touch things. You know, the most valuable company in the world, unless things have changed in the last few days, is Apple. You can go and touch Apple stores. You can go and walk inside and you can see people buying stuff. You can see the what's it called? Steve Jobs' successor. Anyway, totally forgot his name. Tim Cook. Yeah, Tim Cook coming out and announcing the app, you know, the iPhone 15 or whatever. You know, these kind of things are going on. You can see businesses advertising. So once you start to understand the big companies that you're involved in, you can actually start to get more of a feel for why do they make money? What is it that they do that makes money? And therefore start to feel more comfortable about it. But in the kind of broader sense, why might we not just chuck all our money into property because that's something that feels safe and we understand? I think for the last 15 years, that's been something that's been quite difficult for us to explain to people because interest rates have been low. Margins for rent, so the difference between the rent that you receive and the interest rates that you need to pay on your debt, have been large. Certainly 5+ years ago, the taxation environment was reasonably benign, reasonably friendly towards that. And there was that kind of sense of, well, it'll always be there. Now, I think where we're at now, we've had 6 interest rate rises, I think.
Borrowing money's like a lot.
It feels like a lot, doesn't it? So, you know, if we were to go on, you know, into the press and have a look, which in general I would very much encourage you to never ever do because it's usually full of nonsense and not very helpful. But you will see continuing stories about buy-to-let landlords leaving the buy-to-let space. And it's for lots of reasons. Partly, their cost of borrowing, so their mortgages, have got much, much, much more expensive than they had before. It's not an absolute, but there are less buy-to-let mortgages on fixed rates than there are residential. I saw some stats recently that said something like about half of buy-to-let mortgages are fixed, whereas I think it was something like 80% of residential were fixed. So you don't get that kind of locked-in protection. You certainly don't get 5 or 10-year mortgages very often in the buy-to-let space that can fix your mortgage rate. So a lot of people now, there are a lot of buy-to-let landlords who are in a situation where the cost of servicing their mortgages is less than the rent that they receive from their tenants. So you are now, at this moment, for a lot of people, owning a buy-to-let property has moved from being an investment to speculation. And the reason I say that is that, yes, you are still getting rent in as a return, but the costs of servicing your mortgage have gone up sufficiently that, if anything, you might actually be funding the property to keep it alive. So your entire success or failure is dependent on the change in price in that property in the future. So as I say, for the last 15 years, it's been quite a difficult story, because everybody was thinking, well, interest rates are going to be low forever. Rents are going to only ever go up. There's a big gap in between that I can capitalize. Sorry, not capitalize, that's the wrong word, but I can benefit from, and it can provide me an income. So the last year has shown that just because we had been in a period of calm doesn't mean that a period of trauma isn't round the corner. So for a lot of people now, they're going to have to sell these properties because they can't afford to service them. And you think, okay, that's all right, but my property have gone up in value. But again, if you're looking at the press at all, you'll see at the moment property prices are coming down, because unfortunately, the two things are related. The more expensive it is for me to buy your property because of the mortgage, the less money I'm able to pay for it. So we're in this perfect storm, in a sense, that the cost of owning your buy-to-let property is going up significantly because your mortgage has gone up, but the capital value of your property is falling down because everybody else is having the same experience, so they can't afford to buy that property from you. We've had clients, as you know, in our business who, in the late 90s, when there was a massive property crash, had a property portfolio that was worth somewhere in the region of £5 million. And eventually, when they managed to sell out, they just got out without going bankrupt. But the whole thing was lost, and other monies was lost in doing that. And this wasn't somebody who bought, an extra property or two extra properties to generate some money. It was as close to being a full-time job as it. So this was somebody who genuinely understood what they were doing. So it is not a risk-free option. Property prices, again, if we look back over that huge time period, on average have gone up by something like 6%. So when I said earlier, UK companies have gone up by 12%, global companies 13%, properties have gone up by about 6%. Now, everybody listening is going to go, Steve, that's nonsense. My property's gone up so much more than that, and blah, blah, blah. I said, yeah, and that's fine. But your individual experience doesn't necessarily represent the property market as a whole, and it all depends on timing. I can tell you, I bought a property in South Manchester in 2006, and I sold it this year, and it had gone up in value less than inflation, which irritated me enormously, as you can imagine.
I can only imagine.
So the capital value was less, so the spendable value of that property, when I got the money back this year, having sold it, was less than what I bought in the first place. And that was in leafy South Manchester. That wasn't in an unattractive place to live. And I said to the estate agent, why is this happening? That just doesn't make any sense to me. And this was before the worst of the the increases in stuff had kicked in. So it might have been last year I sold it. I think I must be getting old because I can't remember. Anyway, relatively recently, but before the worst of the mortgage increases. And basically what he said is that the view of the buyers in South Manchester have changed. They no longer see where that property was as being sufficiently premium over the alternative areas to pay in excess. Whereas when we bought that property, it was very clear that this was kind of a premium area, and people would happily pay more money in order to be able to buy into that. Nobody could have predicted that was going to happen 15, 16 years ago. So over that period of time, it was a house that we lived in for most of the time. And, I think, as you know, we now live in Spain. So we didn't live there all the time. So we made some money out of renting it. But then when we sold it, actually, the capital return, so the growth in the value of our investment, was less than inflation. So as a return, probably wasn't massively similar to putting the money in the bank. But we'd had some rent, but on that rent we'd paid tax. And again, I touched on this briefly, and I don't want to do it in too much detail, but if you look into it more, there are less and less tax benefits associated with owning property than they used to. You used to be able, basically anything that you spent money on to improve the property or anything, and your mortgage, you used to be able to offset against your rent for tax purposes, and you can't do that anymore. So if we're going to look at trends of on a kind of bigger picture, and that's kind of what we have to do, because everybody, for as much as I can tell you that story about my property, I could also tell you a story about the property that my wife bought 20 years ago and we sold before we bought that property, and it doubled in value in about 4 years. Yeah, so I'm not trying to distort the story, but I just want you to, it's important that you understand that you can do the right thing, buy in the right place, buy what seems like a sensible property, a 4-bedroom house adjacent to 2 highly regarded state primary schools, still didn't make more money than inflation over a kind of 15-year plus period. But the market's going against it, and the reduction in buy-to-let landlords, especially in Scotland, the ever-increasing difficulty in removing tenants from your property, even if they don't pay rent. There's been a kind of an extension of some of the COVID rules around this that have just perpetuated. So it's getting harder and harder to make money out of buy-to-let properties. And the one thing, even when people do make money, they usually ignore is their own time. So as you know, Tamsin, I am absolutely handless when it comes to jobs around the house. So if the plumbing breaks, I need a plumber. If there's something wrong with the electricity, I need an electrician. If the kitchen needs refitting, I need a kitchen fitter. There is virtually nothing that I can do within the property. So actually, I become a reasonable benchmark for this, or case study at least, that a lot of the returns that people get in their properties, if they were truly honest about it, is actually a payment for their labour. So they bought the property, they ripped out the kitchen, they put a new kitchen in, they painted and decorated it, they did it themselves, or they did it in their friends, or they did it on cheap. They changed the carpets and they laid the carpets, etc., etc., etc. Nobody keeps a log, a timesheet, for the time that they've spent doing that and builds that into their calculations. Now, if you're a painter and decorator or a tradesperson and you can round up your tradespeople mates to come and help you, and you're happy that your 9-to-5 job is that, and your side hustle effectively is to do this and get all this work done, you might be happy with that trade. But all I want you to be clear is that a decent part of the return that you get is a reward for your network of tradespeople, rather than actually the property market per se giving you that return. Because if you're absolutely hopeless like I am, and you have to pay market price for all of those things, the return is significantly less. So you're actually getting a reward for work. Now, my argument in many cases would be that I am better spent at work, working, and trying to earn money through what I'm actually professionally qualified to do, rather than trying to earn money in a second job that I'm hopeless at.
That sounds fair. We are coming to the end of our time together, but I'm just aware that there is one aspect that we haven't touched on yet, which is commercial property.
Okay.
So how does that differ from what we've just talked about in terms of residential property?
So commercial property is very different, actually. Commercial property is valued almost always as a multiplier of rent. So when you think about what, and that's both from a surveyor point of view, but also a trading point of view. So people will buy commercial property based on X times the rent that that property generates. Because actually, in that case, they're buying the rent rather than really buying the capital.
Sure.
Commercial properties, again, completely different. People will sign long-term leases. So there isn't that risk that your tenant leaves or whatever. It's predominantly businesses that are going to rent that property. So a lot of the kind of social protections that governments have put in place to private tenants doesn't apply to commercial tenants. There's a few other things to bear in mind. Not always, but a lot of the time, commercial property investments are debtless. People are actually buying the thing outright. Therefore, the yield, sorry, I've just gone jargon again, the return they get, the rent that they get, they actually get all that. It's not that they're having to pay mortgages and stuff like that. The other massive difference is commercial property leases almost exclusively place the entire burden of responsibility for maintenance and repair on the tenant. So if I own a commercial premises that's worth £1 million and I've got a rent of £60,000 per year, I get my £60,000 a year. If something happens with the roof, the tenant fixes it. If it needs painting and decorate, the tenant deals with it. The council tax or the rates, the tenant pays for it. Now, to be fair, your buy-to-let property, the tenant would pay your council tax as well. But all of the costs are paid by the tenant, and the majority of leases will stipulate that when the landlord gets the property back, it must be in exactly the condition it was when it was let out in the first place. So if you've been in, if you're in the tenant and you've put some partition walls or done various things, you've got to knock all of that down and have it replastered, repainted, whatever to make it absolutely perfect. So all of that bit that I was talking about before about me having zero skills and other people having skills but not recognizing the time that those skills were being used doesn't apply in commercial property. So when we're in that sense, the combination of much longer leases. So if you have a building that was let to government or again the kind of big companies, it's not impossible that you would have a 25-year lease. And because all of the costs associated with it are borne by the tenant, you can actually work out exactly, almost to the penny, how much return are you going to get on the property over that period of time. And then you could guess or hope that it goes up in value, but at least you're guaranteed the return for the time that you hold it. And again, commercial premises it's very different in the way that it works. There's less likelihood of huge increases in value through a kind of a supply and demand issue, but there's also risks with that in that sense as well, that if you go into town centres or shopping centres or wherever else, properties kind of come in and go out of favour. And you'll see a lot of the commercial property landlords at the moment are struggling because the tenants are struggling. So if they're struggling, so sometimes you end up with reducing rents and that kind of stuff. But again, because of this basic investment mindset that says I'm going to buy something or a share of something, I'm going to get a return whilst I own it, actually the capital variations in the value of the property become less important, and everything becomes a little bit more predictable. As a result of which, we can then go and look at data over an extended period of time to give us an idea of what normally happens if you make commercial property investments. In the same way that we can get data on what normally happens if you have these bond or gilts, so where you lend money to governments or to companies, and what normally happens over a long period of time if you invest in the biggest and the best and in the best known companies in the world. So we can build models and we can create an understanding of what we expect when we're investing. We cannot do that in speculating because we're into boom or bust territory.
Perfect. That seems like a good place to end this, unless there's anything that you think I haven't asked you that I should have asked.
I suppose the only thing would be that these are not binary choices or binary options. So when you're investing money, again, those four types, so we can put money into a bank account or what we would call investing cash. You can have these bond or gilts where effectively you're getting a return for lending your money to a government or to a company. property, commercial property that you can invest in over the longer term, and companies. What we would routinely do for our clients is have a combination of these things put together. So some money in cash, some money in the gilts and bond stuff, some money in commercial property, and some money in equities. And the way that we make those decisions is based on a number of things, but at its most simplistic, the two drivers are: how comfortable can you get with the ups and downs that the investing market brings? And how much do you need to grow the money that you've got in order to do the things that you want to do in the future? Now, life's easy for us when those two things match. So if your acceptance of ups and downs is consistent with the sort of return that you need in the future, then that's super. That makes life quite easy. But often we find that there's an imbalance between those things. So we just need to have a conversation with people to say, well, what's more important to you? An expectation that you can achieve what you're setting out for the future, or the comfort factor on a daily, weekly, monthly basis that you're used to. So the historically most common portfolio would be something like 60% in companies and the other 40% made up in property, bonds, gilts, and cash. That's defined as the classic balanced portfolio. So just important that people understand that it's not black and white. You can put these things together in a way that works for you. And the only last thing, just quickly, I forgot to say about residential property is, or kind of in the context of that, a lot of the fear that people have around investing in companies is the fact that the prices change on a daily basis. Because on a daily basis, things are being bought and sold. With property, the price is actually changing on a daily basis. You just don't know it because it's not being bought and sold. If we looked at the value of the biggest companies in the world every 5 or 10 years, you would find there's much less up and downs in those prices than you would do if you were looking at it on a daily basis. And that's how we tend to look at property. My property story, we're talking about 15 years plus. I don't know what the values were in between. I'd be really grumpy if I thought that it had doubled in value at some point and I hadn't noticed. But because it's not actually being traded, we don't know. So there's a false sense of a reduced amount of risk associated with a property because it's not being bought and sold every minute of every day. So we apply the same kind of thinking around, well, I know property always goes up in the long term. And in most cases, it's true. Even in my rubbish scenario, it still went up. It didn't go up in terms of inflation. So in real terms, it became less value, but it did go up. The same thing goes for companies. But the trouble is that companies are valued second by second. So it feels more risky because we're actually seeing that variation. I guarantee you that if I had been forced to sell that property in April 2020 or June 2020, when COVID had started, I'd have got a lot less money than I got for it. I also think had I probably sold it the year before that, I would have got a lot more money, but I might be wrong because I'll only ever know when somebody actually parts with their money to buy it from me. So those two things just to think about. The property doesn't have that straight line return either. It just feels like it because it's not being bought and sold every day. And that when you build yourself an investment portfolio, it's a combination of the things that we've been talking about. It's not one thing or the other.
Perfect. That's fantastic. Steve, thanks for joining me today. That was brilliant.
My pleasure.
And I hope you'll keep listening to the next episode, which will be out in a fortnight.